Investing in real estate is a bad idea. Let's have a look. Hello everyone, Florian Heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee, because I thought we'd look at an article here, which is probably, in some quarters in Australia would be considered hate speech and something that should be banned, talking against real estate or saying that investing in real estate is a bad idea. Now, this is an American article, everyone, because I know these articles wouldn't dare to be published here in Australia. So let's have a look at this one. So here's why wealth advisor Josh Brown says investing in real estate is often a bad idea. So people like to stick with what they know. Yeah, that's true. And here in Australia, property is a big part of our culture. Investing in houses is part of the culture. Going to a barbecue, and talking about property, it happens more than you'd think. That and sport. Your home may be your most valuable asset, but that does not mean it's your best investment, according to CNBC commentator and co-editor of the new book, How I Invest My Money. And the equity in your home can be misleading. Well, let's just look at the capital house prices here. You can see asking prices are shooting up over $1 million, everyone, here in Australia for average house prices. 1.1 for all houses, $1 million for a three-bedder. Three-bedder, guys. So it's really a form of consumption. You own the home as opposed to paying rent for a home that you don't own, but you have to live somewhere, Brown said. You should consider your home as an emotional investment. You spend money on it because it makes you happy, according to Brown. Once you start doing the math on home ownership, you will find that decades of inflation, repairs, and renovation leave you with an asset that underperforms the market, Brown said. Investing in more properties can make those returns even worse. Oh boy, that's... How many articles have we gone through? And I'm going to refer to one at the end of this video about owning so many homes by such an age. News.com is flooded with them. People go out of the woodwork and they just say how they usually worked at a crappy casual job, Macca's or Woolies or Coles, and then built up a huge property portfolio. They use the equity from one to jump onto the next, and then the rent, they're living off that. The concern, hopefully they're not all doing it interest only, but I'm sure a lot of them would be. So anyway, that doesn't mean that real estate can't be part of your portfolio. To capitalize on property ownership, Brown invests in real estate investment trusts, or REITs. REITs allows investors to own shares in publicly traded companies that owners income-producing properties. Now, REITs, they're a little different. So the argument Josh is making here is that with all the ongoing costs, with inflation, maintenance and repairs, there could be an issue with regards to owning property, or it's not the smartest way to do it, and to instead go into a real estate investment trust. Now, with my pocket money investing this last year, my goal has been to increase my monthly dividend flow, and a significant proportion of that has been in a variety of different real estate investment trusts over the US. I want exposure to the US market. I want to get paid in US dollars dividends, because there's still going to be demand for the USD, guys. No matter what anyone tells you, there will still be demand for it. And real estate investment trusts are quite unique and unusual because, they provide you with an opportunity to get exposure to the real estate sector and to receive a regular dividend income. I've invested in a variety of those. You can cherry pick which ones you want. I've got into some industrial ones, some warehousing ones. The majority of their warehouses are rented to Amazon. I invested in one here in Australia that owns a lot of retail shopping centers that targets large footprints. They rent facilities for Woolies and Coles and that type of thing. So you can be quite strategic with the REITs. Now, the real estate investment trusts, they're required by law to pay out a significant proportion of their earnings to you. So they can't just start piling cash. So there's special little trusts and businesses that are a little different to other ones. So that's some good advice. And that's an easy way to get exposure to property. You can just buy some REIT listed shares and you can sit them there and start getting a dividend. Here in Australia, it's generally every quarter or every 6 months when you get your distribution or your dividends. There are some that even pay a month. It depends on what you find. Now, this is one way I would suggest you can get exposure to property. And here's the thing, you get there's high liquidity. It's easier to liquidate your asset. If you want to sell your shares in a REIT, you can sell them. If you only want to sell a portion, you can do that. For a house, it's much harder to do, and you don't have any stamp duty, you don't have any of the real estate costs, and you aren't locking a significant portion of your wealth in one location. So I'm a fan of those, guys. Anyway, if you enjoyed that, I want you to look at this other video here. This is one that I promised you, 5 properties by 27 years old. And you'll find, now if you type in, I typed in by 27 years old, and I found like 3 videos I'd done on articles from news.com about people owning so many properties by that age. It really feels like a template. Anyway, guys, I'll see you next time. Bye for now.